All right, let's jump right in. Something really strange just happened in the markets. Gold, the ultimate safe haven asset, just took a massive, and I mean massive, paradoxical nosedive. And it happened at the exact moment you'd expect it to be soaring because of geopolitical risk. So, what on earth is going on? We're talking about a drop of $270 an ounce. That happened in less than 8 trading sessions. That's not a dip, that's a seismic shock to the system. And to really understand how a move that big could happen, we've got to peel back the layers and see what was really moving the pieces behind the curtain. So this is the billion-dollar question, right? Why did gold fall apart when every textbook, every rule says it should have been skyrocketing? Well, the answer isn't about a change in gold's fundamental value, not at all. It's about mechanics, the hidden plumbing of the financial system, and that's exactly what we're going to break down. Okay, so here's our game plan. First, we'll unpack this crazy paradox. Then we'll dig into the 3 financial earthquakes that actually caused the drop. After that, we'll look at the huge difference between paper and physical gold. We'll weigh the bull and bear cases, see what catalysts are coming up, and wrap it all up with the kind of mindset you need to navigate this stuff like a pro. So where did this all begin? Well, it started with a statement from Donald Trump about NATO funding. Now, on the surface, that looks like a political headline. But for the markets? No. For the markets, this was a purely financial trigger. It created this totally bizarre situation where rising global risk, the very thing that should help gold, actually caused its price to fall. That single political comment basically unleashed 3 financial earthquakes, all at the same time. And it's so important to get this, these were mechanical forces. This wasn't a sudden crisis of confidence in gold. It was more like a series of dominoes getting knocked over. So let's break down exactly what those 3 forces were. You had 3 incredibly powerful forces hitting the market all at once. It was kind of like a perfect storm for gold sellers. Each one hit the metal from a totally different angle. The first one, a sudden, violent move in the world's reserve currency. Okay, earthquake number 1. The dollar surge. When it looks like America might be stepping back from its global security role, big money flows back into U.S. assets for safety. And we saw that happen in real time. The dollar index, the DXY, jumped almost 2 full points to 106.1. That's a huge move. And you have to remember this simple inverse relationship here. When the dollar gets stronger, gold, which is priced in dollars, almost always gets weaker. Now for the second earthquake, the yield jump. At the exact same time, U.S. 10-year Treasury yields shot up to 4.61%. This creates what we call a massive opportunity cost. Think about it. If you're a big fund, why would you hold gold, which pays you 0 interest, when you can get a guaranteed 4.6% return, risk-free from the U.S. government? That simple math right there pulled billions of dollars out of the gold market. And this brings us to the third, and maybe the most misunderstood earthquake, forced selling. I want to be crystal clear here. This was not panic selling. This was mechanical. It was the end of the quarter, and huge funds had rules that forced them to sell. Their computer models just said, hey, the portfolio is out of balance. Sell your best performing asset to get back in line. It's automatic. It's not emotional. In a weird way, gold was a victim of its own success. Now, to really get what happened, you have to understand the battlefield. You have to understand the difference between the paper gold market, which is where the price is set, and the physical gold market, where actual gold bars are being bought. Because during this whole event, they were telling 2 completely opposite stories. So, the paper market, it's all about futures contracts and exchanges like the COMEX, and they use insane leverage. It's like owning a picture of a house versus owning the keys to the actual house. Get this, for every 1 ounce of real physical gold sitting in a vault somewhere, there can be up to 400 ounces of paper gold being traded. That leverage just pours gasoline on every price move, and that's exactly where all that institutional selling hit. And you can see this pressure in black and white when you look at the data. The 2 biggest gold ETFs, GLD and IAU, saw $1.4 billion fly out the door. This is the smoking gun, a clear picture of those big institutions dumping their paper gold positions to rebalance their books. But, and this is a huge but, while the paper market was on fire, the physical market was telling the complete opposite story. Central banks, we're talking the smartest, most patient money on the entire planet, they stepped in and scooped up another 72 tons of physical gold. This isn't just buying a dip, this is a major strategic move. It's a signal about their long-term view of the dollar. The people who think in decades were buying, while the people who think in quarters were selling. This huge split between the paper sellers and the physical buyers, well, it sets up two powerful and totally competing stories for where gold goes from here. It's a fascinating tug of war. So let's take an honest look at both sides, the bull case and the bear case. Okay, the bull case. The folks who see gold going to $2,800, maybe even $3,200 an ounce. Their argument is built on four main pillars. First, de-dollarization isn't some conspiracy theory anymore. It is official policy for countries like China and Russia. Second, the U.S. fiscal situation is frankly alarming. Third, major geopolitical risks are just not fully priced into the market. And finally, from a pure chart perspective, the technical setup looks really compelling. And just to hammer that fiscal point home, look at this number. $34.5 trillion. That's the U.S. national debt. And historically, when a government's debt chart starts to look like a hockey stick pointing straight up, smart capital quietly moves into hard assets like gold, just as a way to store value outside of that system. On the other hand, you have the bear case, which sees gold potentially falling back to the $2,000 to $2,100 range. That argument rests on the idea that the U.S. economy stays strong, which would keep the dollar high. There's also new competition from crypto for that safe haven money. And if we get a major stock market correction, investors often sell gold first because it's liquid, and they need the cash to cover losses elsewhere. So you've got these two powerful narratives clashing. How do you actually track which one is winning? Well, it's not about guessing, it's about watching the catalysts. So let's pivot from the big theories to the specific, actionable events that are probably going to dictate gold's next big move. First up, and this is a big one, is the core CPI inflation reading. This is basically a binary event. If that number comes in hot, let's say 3.6% or higher, gold might take an initial hit, but then the inflation hedge story becomes so powerful that it could rally hard right after. Now, if the number comes in cool, say 3.2% or lower, you can probably expect an immediate pop of 50, maybe even $80 as bets on Fed rate cuts come roaring back. And over the next few weeks, you're going to want to circle these dates on your calendar. April 10th, we get the Fed meeting minutes. Then, mid-April is corporate earnings season. That could tell us if a stock sell-off is coming. April 22nd, the IMF's economic outlook has a history of moving the gold market. And all the while, the Iran nuclear talks are this huge wild card in the background that could send prices soaring overnight. Look, knowing the dates and the data points is one thing, but having the right psychological framework, the right mindset, that's the whole game. So the most important question is, how do you navigate this kind of insane volatility without making big emotional mistakes? Let's just take a quick look at history. Back in the 2008 financial crisis, gold got hammered. It plunged 20% right in the middle of the chaos. All the experts on TV declared it was dead. But guess what? 18 months later, it rallied 163% to a new all-time high. The people who panic sold at the bottom missed that entire life-changing move. The patient buyers, they were rewarded big time. This history lesson teaches us four really crucial things. First, you have to start seeing corrections not as failures, but as reloading opportunities. Second, you have to learn to separate the signal, like central banks buying tons of physical gold, from the noise, like forced quarter-end selling. Third, focus more on your position size, on how much you own, not on trying to perfectly time the absolute bottom. And finally, just understand that real wealth is often built by calmly buying an asset from people who are selling it in a panic. So ultimately, this whole episode, the sharp, violent correction, and all the hidden forces behind it has created a truly fascinating setup. We've seen the mechanical reasons for the drop. We've laid out the fundamental arguments for the future. So the only question left, really, is this volatility has created a trade. Which side are you on?